Today we're going to be talking about property taxes, preparing for property taxes, the correct way to underwrite the property tax expense. This is a huge, probably the most important underwriting assumption you can make in multifamily acquisitions. The reason being, it's just the largest line item. It is the largest expense line item that there is on majority of multifamily acquisitions. And the complex part about it is that each state and each county in those states have different rules and regulations, and obviously politics come into play. We're not gonna get into the politics aspect of it, but I think it's very important to just talk about the correct way, because one small mistake can cost you hundreds of thousands of dollars just depending on the scale of property you're buying. For example, I think one of our largest tax bills for one of the 16 or 17 multifamily properties that we own is close to $2 million a year. So one small error, one small percentage can mean $100,000 difference. Now, that being said, I think there's a few bullet points here that are going to guide me through this. And the first one says use a consultant service. Experts are key to success. Just as you're doing your normal taxes, it's best to leave it to the professionals, or get your work checked by a professional to make sure you're doing the best that you can, you're the most accurate you can. And that's the exact same thing on property taxes, especially when you're going to make assumptions for the future. Now, we're not shy of using third-party consultants to help us with not only our appeals, but also some assumptions. They know the counties and legislation the best, and the rules and all that. So a lot of times we will ping them. A lot of times it's free. We'll ping them. We'll get their expert knowledge, and we'll use that for our underwriting. So the third party that we use is called Ryan Tax Consulting. They've been exceptionally great for us. And typically, they only charge you if on an appeal, they'll only charge if you win. So I think the most important thing here is just don't be shy to use experts for small advice or big advice. And that being said, before you go to an expert, you obviously want to use the best of your knowledge before you just go to an expert and say, hey, I don't know what I'm doing here. At least you need to make some assumptions. You need to gather some data, etc. And a lot of the tax data, every single tax data is public record. You can go to a county website, say you're looking to buy a property in Charleston County, South Carolina. You type in Charleston County, every past year of every single property is online. You can use a GIS system to help you search for that property, and you can make assumptions. You can even, so there's two things in taxes. Let's start from the basics, right? You have your millage rate or your tax rate, as well as you have your assessed value. Now, those two things can be wildly different in different counties, and how they're taxed. So residential is different taxed than commercial, and so on and so forth. So once you get your previous appraised value or assessed value, and you have last year's millage rate or tax rate, those are both public data. That's your starting point. So you get, and then a lot of times there is something called a reassessment year. So all this is public information. You look up Charleston County, how often is there a reassessment? And I know because I work in South Carolina a lot for multifamily acquisitions, is that South Carolina is on a 5-year cycle for a reassessment. Sometimes it's 4, sometimes it's 5. And North Carolina is, I believe it's 8 years. And they're legally required to do it every 8 years. And a lot of counties go by 4-year cycles. Each county is different. I'm not going to talk specific counties, but that's just something I know off the top of my head. Again, public data. And I also know that South Carolina, if you purchase a property the following year, you're going to be reassessed. Where in North Carolina, that's not the case. So these small little nuances to underwriting can be wildly different in how you value a property. For example, if you say 2024 was a reassessment year, both in both in South Carolina and North Carolina. If I was to underwrite a deal that was one was on the North Carolina border, one was on the South Carolina border, and they're the exact same property, they have the same exact value. If I was to underwrite the South Carolina, I would underwrite it different because the following year after the purchase, after we acquire that property, those tax bills or that assessed value is going to shoot up, and therefore your tax bill is going to shoot up. Whereas North Carolina, they are not going to pick up that new assessed value or that new purchase price that you just paid for, assuming that it's higher than the current assessed value. And they're not going to pick that up until the following reassessment year, which will be potentially 4 years down the line. So you have a locked in assessed value for 4 years at that lower value in North Carolina. And then there's these nuances throughout the states, obviously. So for example, a lot of now this isn't a general rule, but a lot of states that do not have state income tax, a lot of times they're reassessed each year, right? They need to pick up taxes in other ways because there is no state income tax. So for example, Florida and Texas, they reassess every single year. That's a lot because every time they reassess, traditionally your assessed value goes up and they're able to bill you for a higher property tax. So I'm just trying to give little examples as to why it's super important to know all this. And it's everything that I'm sharing with you is public data. It takes a lot of research, but it's as simple as I'm using Charleston as an example because it's an easy county to navigate. At least on their website, you just type in Charleston County millage rate and you'll have a whole millage card. You type in Charleston County reassessment year, it'll pop right up. So things like that. I think that's a great. I'm touching upon the second bullet point. Use public data and county websites. With all that being said, a lot of the things I'm sharing is living up in my head, but of course I have this written down and as a company, as PassiveInvesting.com, we have a shared Excel sheet that has all this data. We know that I saw someone who's coming in from Tennessee, Davidson County. We know that they assess a different way than I'm sure that they assess differently in Knoxville, Tennessee. So this is all written down on a page on an Excel spreadsheet that we have internally. And every time we underwrite a deal, whether it's South Carolina, North Carolina, Florida, Texas, Georgia, wherever it may be, we at least have some entry-level data that we know how to start our underwriting. And once we get deeper into the underwriting, say we actually want to offer on the property, we can fact check that. We can say, okay, did we make the right assumptions? We can go to a third party and consult them and just make sure that we're on the right path. So down the line, we don't have a exceptionally large property tax bill that we were blindsided by. And sometimes that happens. Sometimes you'll have someone in the county level that is new, that has come from the assessor side and use his knowledge and will increase assessed values heavily because he'll know the county and what's property is traded and etc. So sometimes you are blindsided, and again, that's why you do use that consulting firm because they'll help you determine if an appeal makes sense. Now, this webinar is geared to preparing for the correct way of underwriting, but I think it really plays into a huge part on the back end is when you buy a property, your tax journey is not over. It's just begun. Again, I see that. Excuse me, I see someone just wrote. I'm just seeing registration on your screen. I'm not presenting anything specific. I don't have notes that I have to share. I'm happy to go through potentially just Google searching a county, and we can go through that journey together. But I'm just speaking freely here. So if you have any questions, again, don't hesitate to reach out in the chat or the Q&A. So what I was saying is your tax journey just begins when you acquire a property, right? You still have to, first off, you have to operate the property. And one of the best ways to saving money and saving expenses is to appeal your taxes. Obviously, you need to have good reason as to why you feel. Now, what you're appealing when you appeal a tax And every county allows you to appeal your taxes. And there's different processes, and it can get quite complex, but I'll keep it general. Say you appeal a tax for 2023. First off, you have a specific time to vouch for your appeal, or literally appeal. Now they can deny you and say, here's why your appeal doesn't make sense, or it's not, you don't have a case. And sometimes they'll have informal hearings and they'll hear your case, and they'll say, well, why do you think it's, for example, not 50 million? Why do you think it's 40 million of assessed value? You're appealing your assessed value. Now your millage rates or your tax rates, that's all predetermined by your county level. Now that's something you can appeal separately, and you go to a town council and all that, and be part of the voting. And that's where the political aspect comes into. However, in a property owner aspect, you can appeal your assessed value. And how your assessed value is determined is different in every county. It could be based on your purchase price. It could be based on like-kind property that's also traded hands, so a deed transfer. It could be a percentage of your purchase price, but a lot of times it is. But in states like Texas, where there's non-disclosure, you don't disclose your purchase price to anyone, including the counties, including the appraisers, etc. They determine it based on appraisals and income valuation. There's just a plethora of ways that they can determine a value. And if you feel that they're wrong, you obviously submit that appeal, and you need to build a case, whether you say, okay, here's our true income. You show them your financials, and you say, you overvalued our property, and we really feel that this is worth less, and therefore you have a less tax bill. It's different on residential. I think residential, I don't really want to speak to residential, but I believe it's just on sales comps, not income. Obviously, in single family, you're not having income, even though that's changing. But I think what I'm trying to express here is that, yes, you need to properly prepare for your property taxes so you can correctly valuation property. However, the real work begins on the back end and making sure your tax bill is aligned with not only your underwriting assumptions, but just with your true belief of, does the county have a correct vantage point of the valuation of this property? And I bring that up too because I think it's really important to see that in the past couple of years, as we probably all know, real estate in general has blown up. Valuations have skyrocketed because incomes have skyrocketed, because rents have increased, and therefore there's been very high valued transactions, and there's a lot more data that favors the counties and the assessor's office to lean into to increase your assessed value. And therefore we've seen a significant increase in tax bills. And now, we're in this point in the market where valuations are starting to cool off. You're not seeing as much rent growth. And it's starting to come back into the operator's favor of, listen, here's some trades that are not so hot. We've seen some distress at the market. You can lean into those and prove a good point of, you currently have our valuation up here, but in reality, in today's market, it's down here. And it's a balancing act, right? So there's a lot that goes into tax appeals and justifications as to why on tax paper your property is worth less. It's an interesting balance, right? Because you don't want to prove that your property is a lesser value than when you go to sell it, and you're obviously trying to get the most expensive value. So it's a balancing act, and it's something that there's nuances to each county. And again, as a acquisitions platform and a company, it is crucial that we use those third-party consultants where they do this day in, day out, and they know the nuances, they know the people that sit at the county level, etc. I'm going to take a pause here. I want you guys to direct this with your questions or concerns or anything before I just continue to ramble. I want you guys to get the most out of this. So please be sure to write your questions or concerns or threats or anything in the chat box. Okay, I see Kevin just wrote a question in the chat. Thank you. When you are underwriting a multifamily property, what percentage tax increase do you use on your pro forma? Now, assuming you're saying from current in place or previous year taxes to your pro forma or your following year. Now, that's a great question, and it's hard to answer because it depends where we're talking, right? I think I can go back to the analogy of North Carolina versus South Carolina. So North Carolina, say we're not in a reassessment year for the upcoming year, you'll see an increase of maybe 3 to 5%. And what's moving is not your assessed value, it's your tax rate that bounces up and down. And sometimes in counties that don't reassess every year, they'll try to their millage rate or their tax rate will bounce up a little bit more than a county that over here where your assessed value is bouncing up and down, they'll try to keep the millage rate a little bit more stable. Now, that's a little complicated, and I hope I painted a good picture, but what I'm trying to say is in a specific county where your assessed value is not changing, you'll see increases of 3 to 10%, 10% being an extreme case. Whereas, for example, South Carolina, say you bought a property that was previously purchased in 1990 and the valuation is $10 million in an assessed value county perspective, but the true value of the property in today is $40 million. That following year, they're going to pick up that $40 million instead of $10 million. They'll take a percentage based on the county. Typically in South Carolina, you can apply for an exemption of 25%. So it'll be 75% of the purchase price. And you'll have almost a, nearly 300% increase on taxes, on property taxes because of that. And this goes to my point of like, you really need to know the jurisdiction in which you're operating in when it comes to the county level, because just putting a flat rate percentage of okay, there's going to be a 5% increase of taxes. Well, that's a complete gamble and guess, and you're probably going to be wrong. Now, Kevin, I think this is important to note because say, we're not underwriting just for the following year when it comes to multifamily underwriting, right? You're underwriting on a pro forma from anywhere from 3 to 5 to even 10 years. And there's even owners out there that, buy and hold forever. Obviously, that's not what we do here, right? You need to give your investors capital back, obviously, or their capital gains. So what we'll do is we'll not only underwrite for the following year and then just put a flat rate 3-year, 5-year percent increase year over year. What we'll do is we'll make sure we align a timeline of when we purchase the property. We'll align with the county of when the cycles are for reassessment. So for example, if that's Texas, we'll make sure we have a higher increase year over year. But if it's North Carolina, we'll have a standard, for the years that it doesn't reassess, anywhere from 3 to 5% increase. And then when it reassesses, say it's 2027, for example, in that pro forma of our underwriting, we'll go into 2027, make sure we make a correct assumption. Now, a lot of times those assumptions are assumptions. It's, again, good to fact check it with your consulting service, but it's really difficult to project or predict your property tax bills in, call it 5 years, because you can have a market upturn, downturn that affects not only all the values in the county of multifamily properties, but especially your property. And you can also have litigation change. You can have people in the county level that change, that have wildly different perspectives of how taxes should work. And that happens a little less frequently. But things like that, you can have a lot of different factors outside the realm of your control that can completely destroy a normal assumption of 3% on your property taxes. And that's why I think it's important. This webinar is just to show that there is a ton of due diligence of time and due diligence you need to put into your tax assumptions and your taxes on the back end once you own that property. A lot of moving parts, as you said, Kevin. Yes, it's not a one simple answer of yes or no, 5%. It is a complex, um, just as like your normal property or your normal income taxes are, right? It's a complicated uh, operation, or there's so many moving dials and levers you can pull and whatnot. And it's the same thing on your property taxes. Wow, I am rambling here. I'm going to take a sip of water. I hope a question comes in. I feel like I covered everything that has come about here. I can maybe touch upon more tax appeal stuff. We're under a few tax appeals now, so I'm really in the weeds on some multifamily properties, and I can speak to them. But if not, I might just end it here. But just again, reach in with any questions, concerns. If not, we'll wrap it up here shortly. If you guys have any questions on property taxes or just want to speak to me, my email is chris@passiveinvesting.com. I'm not shy when it comes to responses. I try to do my best. I hope you guys took away anything, whether it was just go in the county and do some research or whatnot. But I hope this was helpful. And it's always nice to see you guys come in. Andrea did just put a question of tax abatements with a question mark. I'm not sure exactly what you want me to touch upon, but yes, I could do a whole nother webinar on tax abatements alone. It is an interesting topic. There are many tax abatements out there. There's even tax exemptions that you can apply for as a property owner that are separate from abatements. So I could speak to maybe the property that we have that's in a tax abatement. It's in North Carolina, and the way it works, it's a step down essentially. So as time progresses, you have less of an abatement. And when we first owned the property, it was 90%, meaning we only pay, they tax us in a normal level. They have an assessed value, they have a millage rate, and we only pay a percentage of that. When we first purchased the property, we were paying 10% taxes, which is phenomenal. That's hard to beat. Then it was stepped down. The next year it was 75%. The next year it was 50%. And I believe we have a few more years remaining. And those are interesting things to, obviously it's a lot more complicated underwriting the deal, because you have to, each year takes a lot of time to correctly underwrite. But this obviously helps with valuation. The less taxes you pay, the more NOI you have, the higher the value of the property. But as time goes on, you lose some of that NOI because your tax bill gets higher. So it's an interesting balance of how do you value this today when you know on the back end a new buyer is going to have a lot higher taxes. So how do you do that balancing act? So tax abatements are pretty complicated but incredible. Where they come from, there's many ways. There's Brownsfield, there's development tax abatements, there's one on the tip of my tongue that I'm forgetting, but I can go on. And if you have specific questions, Andrea, on that, please don't hesitate to email me. Okay, I'm gonna wrap it up there. Thank you all very much. I hope you enjoyed and have a great rest of your week.